term payment for order flow, it's something that's really kind of hit into the mainstream this year in a way that I think none of us really expected at the outset of 2021, largely due to theories surrounding Robinhood halting trading and GameStop and some of these other companies earlier this year. Just for those of you out there who may be unfamiliar, payment for order flow essentially means that it's these brokers, including Interactive Brokers and Robinhood, that generate revenue from selling the order flow to market makers who are able to execute those trades. Now, what's the likelihood, Thomas, that you think that payment for order flow is actually banned in the United States? You're a man who deals with lots of numbers. Can you put a number on this likelihood?
First of all, I must correct you here. Interactive Brokers sells less than 3% of our order flow. For the rest of it, we execute ourselves and we charge a small commission. And we generally are able to get a better price because we get institutional orders that we can offset the retail orders against. Now, the probability, well, that's a tough call. I think that the probability is not higher than 20% that payment per order flow will be done away with, because if payment per order flow were prohibited, that would incentivize market makers and brokers to merge. Once they merge, they have a trading department, a sales department, and the payment is not overt, it's internal within the same firm. And now if that happens, that draws a lot of focus on the fact that business has always been done like this on Wall Street for over 100 years. The large banks have a sales department and a trading department, and they just internalize the trade and internalize the payment, and nobody knows anything, so nobody focuses on this issue.
So I want to go back to your point about having the brokerages and market makers merge as a result of this, having the incentive if payment for order flow were banned. So you're saying basically that a Robinhood and a Citadel Securities would come together in a merger. Why would that be incentivized by the banning of payment for order flow exactly?
Because then they could do the same thing they are doing today, but Robinhood would no longer have to publish how much money it received from Citadel for the orders. Right?
So it's basically getting around, it's a loophole, you think, in the way that they would ban it.
And that's how large banks, the large bank brokers operate today, right? So they receive the orders from the customers and they send it to the trading department to trade against the order, right? The trading department makes the money trading against the order, and the firm internalizes the profits. So there is not an overt payment that would be, except you can read in the quarterly earnings statements the so-called trading profits of the large banks, right? And they are every quarter there are billions of dollars, $2, $3, $4, $5 billion a quarter, right? Suddenly, if Citadel and Robinhood would merge, that would focus on everybody's attention on this specific issue that's been going on for years with the large banks. So what could Gensler do about that? He could say, okay, we are not going to allow any more trading against customer orders by firms. All orders have to be routed to exchanges where there is free competition that the order is subjected to, right? But I think that would be very difficult to swallow by the big banks.